Noon. It is 12 o'clock when I am recording. It is February 10th, 2026, but you might be watching this another day. You might be watching this another time because, as I said, we're recording this and it'll be available to you on YouTube and video. This is Multi-Household Families. As part of the Lunch and Learn 2026 tax series. It is brought to you by the Low Income Taxpayer Clinic at Legal Services of Northern Virginia. I am Valeshka Watkins. I'm a senior staff attorney and qualified tax expert. And it doesn't take an expert to tell you that tax filing season is upon us. It started January 28th. It's going to close on April 15th, unless you ask for an extension, and we can talk about that a little bit further. But let's assume that at this point you are going to file your taxes on time and you have some general concerns because you are part of a multi-household family. First, we're going to talk about the IP PIN, the Identity Protection PIN, and how it relates to this topic. We'll give a little bit of a tax 101 so that the concepts we discuss make sense as part of a puzzle. And then we'll discuss a little bit about common tax conflicts in multi-household families, and then tax relief for those families that are seeing the breakup come about as part of domestic violence or intrafamily abuse. As always, it's important that if you are going to be opening an account and providing your personal information, that you do so from a trusted beginning website. So I recommend that you go to irs.gov, or you can do a search on your preferred search engine for the irs.gov ID Me, or you can say IRS profile. In any event, it will bring you, hopefully, to creating a new account if you don't have one. When you do, make sure that you're sitting down in front of a laptop. In theory, you can do it from a mobile phone, but it gets clunky. I've tried it with some clients and it's just not as effective and it tends to slow down. So it will take you to the Create an ID Me account. You're going to provide your email, choose your password. Once you do that, it's going to start by asking you to take a picture of the front and back of a government issued ID. And then it's going to want to see your face. It's going to take a short video of your face, and it will send you a code, right? All these are things to confirm your identity. It looks at the picture on your ID, it looks at the video on the laptop, and then it sends a code that you're going to input on the website. The same will happen every time you want to log in, just to make sure that it is you trying to log in. When you reach that page, you're going to be able to see many things about your profile. If you're on a payment plan, it will show you information specific to that, if you owe anything and want to establish a payment plan. But importantly for us, it's going to allow you to request an identity protection PIN. This is a 6-digit number. That might change, but for now it's a 6-digit number, and it is something that you will need to input into your tax return so that the IRS knows that you, the person with this profile on the IRS website, is the person inputting the information on that tax return. It helps prevent identity theft. And we usually think of this as a stranger stealing your wallet, using your information to open accounts, but it also happens sometimes when there's problems, when there's discord in the family, perhaps a former spouse wants to use the information of the other to file taxes or for other purposes. Here in the screen, you're going to be seeing the signature portion of your tax return. Once you or your preparer has inputted all the information, if you have an IP PIN, that has to be included there. If you have also requested IP PINs for your children, then in the portion where you list your dependents, which could be children, it could be your parent, anybody who's a tax dependent on your return, there's also going to be portions there for the IP PIN. Without the correct IP PIN, the IRS will receive the return but reject it as fraudulent. The preferred method for the IPPN is the online process that I just described. If you don't have access or ready access online, you could do it by mail or you could do it in person. It's going to be a much slower process. It can take between 4 to 6 weeks for you to receive the IPPN after the IRS has called you to verify your identity. In the case of a mailing, in any event, you want to do it early in the tax season because if you wait until later, you might not receive the IPPN in time to file your taxes. If you don't owe any taxes, that may not be such a problem. But if you have to pay, then remember that when you file late, there's going to be those fees added to your account, and there's no point in doing that. If you lose it, but you requested it online, all you have to do is log on to that IRS account and it's going to show it to you. If instead you have requested it by mail or in person, you would have to call the number and they would again verify your identity, and it would take a few weeks again. So it's not something that you want to be happening in the middle of the tax season. Okay. So I'm talking a lot about tax return, and I should say that if all of this so far sounds a little bit intimidating, and if you don't feel extremely comfortable preparing your own tax return, you should try to contact one of these two organizations. The Volunteer Tax Assistance, VITA, or the Tax Aid by the AARP are organizations staffed by trained and certified individuals. They provide high level of service to most income tax payers, income tax filers that would come to Legal Services of Northern Virginia. You would have to be extremely high income for them to not be able to service you. They call that out of scope. But they are all around Northern Virginia. And if you're out of state, they also have sites throughout the country. Okay. Some of the things I'm going to talk about are going to be relevant to employees, to individuals that are going to receive a Form W-2, or that should have already received it, really, as of January 31st. They're employees, they have benefits, they have a stable contract with their employer. Their employer withholds taxes, a portion of their taxes, with every paycheck throughout the year. There's also individuals who are independent contractors. And when you're an independent contractor, you might not think about you as your own boss, but you are. Because the person that is employing you is not withholding some of the taxes that are withheld for an employee. These are the self-employment taxes. Some of it is going to go to Social Security, and some of it is going to go to Medicare. Social Security, if you don't know, is an amount that you're going to be receiving after you retire, and it's like a savings account in some ways. Now, if you are self-employed because you're an independent contractor or because you have your own business, 12.4% of whatever you're seeing on your check every month or every 2 weeks really should be reserved to send to the Social Security services, so that they will hold that in a trust for you until you retire. 2.9% is going to go to the Medicare, and that is going to provide you health care coverage when you retire. You could also buy other health care plans, but this is something that's going to be the minimum that you're going to receive once you're no longer a part of the workforce. If you don't know, well, you should know by now because you should have received either a W-2 or a Form 1099. But talk to your employer. It's going to be something that affects both your tax withholdings and your filings, but it's going to affect the quality of your life because if you're an employee, you have benefits, you have time off, which are things that you don't necessarily have as a 1099 worker. Now, what's really important for those who are W-2 workers, employees, is that when you are first being hired or promoted, you have to fill out a W-4. That is the form that tells the employer how much money to withhold for your taxes. There are websites, there are tools online that you can use to help estimate. But generally, the factors that are taken into account is your tax status, meaning are you single? Are you a head of household because you are single but have dependents? Are you married, filing jointly or separately? And do you have some need for an additional withholding or not? Sometimes people have two jobs, right? They have a W-2 job and a 1099 job. And because they know that the employer for the 1099 is not withholding taxes, they decide to withhold a little more on the W-2 side to even out the situation. Now, something that can happen when you have a multi-household family is that you can agree through the execution, the signature of some IRS forms, to switch every year or every other year the dependency status of your children. Now, that's going to be important because you're going to have to adjust accordingly. You don't have to, but it will benefit you if you do that. So you have to be very vigilant and follow the trail of paperwork. This is what I said you would have to fill in and provide to the IRS. The IRS, absent this form, is not going to care about other arrangements that you have made, even if they are through the courts, through the state courts. The IRS needs you to execute, to sign this document, specifying who will be treated as the custodial parent for tax purposes on any given tax year. What this means is that if normally the children are living most of the year, more than half of the year, with one parent, the other parent is not going to get to claim them as dependents unless they execute this agreement and then switch between one household and another. And that way, everyone can get the benefit of claiming these dependents and receiving some of those child tax credits or earned income tax credits for the children. Now, I don't want to just abandon 1099 independent contractors and self-employed. Remember that you're going to have tax obligations that are going to be hopefully written down and found on those 1099s. It could be 1099s NEC, non-employee compensation, or 1099 miscellaneous. If anybody has hired you and paid you more than $600 a year, they have an obligation, a legal obligation to provide you a 1099 that reflects that. If you don't receive it, don't assume that they haven't sent one to the IRS. They may still have reported what they paid you to the IRS, but because of an experience of incompetence or because the mail gets lost, you haven't received one. So you should talk to the person that employed you and paid you that much to see if they can provide you a duplicate. Even if they don't, hopefully you have copies of your pay stubs, you have your bank account. You can figure out how much you were paid so that you can comply with your tax filing and possibly payment obligations. If you are a gig driver, so on Uber, Lyft, DoorDash, remember that some of your compensation might not be reflected on the 1099, but it could certainly be reflected on all of those useful charts and documents that Uber, Lyft, and DoorDash, etc., prepare for the contractors so that they can, for example, figure out their mileage, fees. Sometimes tips are reflected as well on those. So those are important documents to keep with you. Other things to remember if you are self-employed is that we have to report cash earnings. We might not want to, but we should. Remember, a part of what you earn is going to go to your retirement. It's been set up as a trust. The social services and, the Social Security and the Medicare trusts are going to hold those monies for you until you retire. What you pay in taxes, even if you're including all this cash, is going to be not necessarily that big amount that you receive. Remember, if you are self-employed, you can deduct your business expenses. They have to be necessary and ordinary for your business, but you can deduct it. You're not going to be taxed on all that comes in. It's a balance. And it is important. You might not be receiving any 1099s because say that what you do perhaps is mow lawns, right? Or you bake cakes or whatever it is. You are receiving monies that are not documented in one of these forms. But if you have earned $400 per year or more, you really need to be reporting, and you're going to be expected to send a portion of that, like I said, Social Security and Medicare. There is another 1099 form that tends to be relevant both for independent contractors and for multi-household families. And it is the 1099-K. That is the form that reflects electronic payments on platforms like PayPal or Zelle or Venmo. Generally, we have come to assume that these have to do with business transactions, or perhaps with your friends reimbursing you because you went together to the restaurant, someone paid, and then okay, like I'll Zelle you or Venmo my part of whatever we spent. There's going to be perhaps a presumption from the IRS that if you are receiving more than $20,000 total through this platform, and there are more than 200 transactions making up that 20,000, that these are transactions that reflect income. So it is really important to include those little notes like, what is this for? Tips for my hair, or reimbursing, or gift. Because you want to make sure that if you're examined or audited by the IRS, because you're seeing a lot more money than what you are reporting as income, you have a way to prove that it was an income, that it was reimbursement. It's important, if you receive a form like this by mistake, immediately contact the company, because someone may have stolen your identity. There may have been just a mistake, a typo that ended up creating a form for you. But it's really important because if you receive the form, the IRS received the form. So you really want to correct the problem as immediately as you can. In terms of the multi-household families, I would say that you should probably reconsider, because it may be that the child support payment or the alimony payments that are going through these platforms are so large that they would trigger the idea that they're income. And so even though you can send to the IRS a copy of the settlement agreement from the divorce, the copy of the child support agreement, it's still going to be laborious. I don't want to insult, besmirch, or in any way disparage the IRS, but things take time. They feel like they're quick to collect any debt, but then during the exams and the audits, they can take time, and that's stress that adds to your life, especially if there is the possibility of a lien or a garnishment, because they think you owe money. Very well. All of these things are only important if we have to file a federal tax return. If we don't, we really don't even have to worry. If you are a 1099 worker, remember, and you have net earnings, employment over $400, you have to file. Net earnings would be like you have bought your lawnmower, you have bought, let's say it's not electric, right? You have bought gas for it. So those are expenses. If after you deduct, after you subtract those expenses, you have $401, then darling, you have to file your taxes. You also have to file your taxes if you have been buying your healthcare insurance, obtaining coverage through the Patient Protection and Affordable Care Act, which some people lovingly and some people hatefully call the Obamacare exchange. Okay. If you have that, you're going to receive a 1095A, and you're going to take that to your tax preparer and report all of the payments. Very well. There's also something that it's important, and I have it right here. It's not circle because it's an oval, but signaling it. If you are married filing separately and you have earned $5, you have to file a federal tax return. That is important. The IRS disfavors this and really wants to keep track of those tax returns and of the individual's comings and goings in the job force. It's a policy decision. We just have to go along with it. Now, more commonly, right, once there's been a divorce, you are going to be a head of household unless and until you remarry. It is also possible, I should say, and I guess maybe I'll make the oval bigger next time, that you could be a surviving spouse. But in that case, you wouldn't really have the kind of controversies that would require you to plan to see who can claim the kids. Because arguably, if you're a surviving spouse, you're a widower, there really isn't that debate going on anymore. Now, if you are a head of household and you're under 65, you have to look at the income that you earned. And if you earned at least $23,625, you have to file. It doesn't mean you have to pay. In fact, that first amount, those first $23,625 are protected from taxation. And it may be that you earned more, but you qualify for credits or you qualify for some other deductions if you itemize, and you might not have to pay, but you have the obligation to file. The number is bigger, $2,000 bigger if you're 65 or older. Now, it is important that maybe you haven't earned this much, but you should still file a tax return to prevent identity theft, like we talked about. For example, there are individuals who receive Social Security retirement, and they don't have to file, but it is really important because if you don't use your Social Security, if you're not filing your tax return, someone else could steal your Social Security number, start using it, incurring tax liabilities to your number that you will then have to challenge or pay, and that's no fun. Another reason is, as I was mentioning, you may be entitled to some credits, child tax credits, earned income tax credit. If you don't file, you don't get those monies. We especially want people to get access to the refundable credits, which means that it is credits that you can put in your pocket, put in your bank account, even if you don't owe any money to the IRS. One of those is the earned income tax credit. And as it says, you have to have earned income. You must have worked. Unearned income would be something like the interest on your bank account or on a certificate of deposit. Passive income, like investment as well. So this tax credit is intended for individuals that work. There is a limit. It is not available to higher income earners. So here we have a chart that shows, depending upon your tax filing status, single, head of household, married. and how many dependents you have, 0, 3, or more, there's going to be a limit. And after you hit that limit, you will no longer be eligible for the earned income tax credit. Now, I have simplified this. When the IRS reviews your tax return, they have complicated charts that determine how much money you're going to receive as a credit. So if you have 0 dependents, that's going to be one amount. If you have more dependents, 1, 2, 3, etc., there's going to be more, but that amount is going to be affected by the age of the relative or the child. As the children grow older, the extra amount we get on credit grows smaller. The idea is that there are more expenses when the children are smaller than when they are older. There are requirements, and some of them are new and some of them have been established for a while. So new to us and very important is that both the parent and the child have to have a social security number. If we're talking about a married couple, that means at least one of them has to have a social security number. The other one can have an ITIN. If we're talking about couples that are already divorced, then what that means is that if one of the parents does not have a social security number, that parent with the ITIN number can never have access to the earned income tax credit. And we would want to let the IRS know that regardless of the actual place where the child lives, I should correct that. Regardless, the child has to live in the United States, so that's a bigger place. But by place, I mean the household. We have to report to the IRS that we want the U.S. citizen taxpayer to be able to claim that child for child tax purposes. Remember the form I told you about? You can fill that out. I would hope that the parents have a strong enough communication after their separation, after the relationship has ended, that they can negotiate this, because really that money should be thought of as covering the children's needs and perhaps saving it for the children's future. It shouldn't really be thought as a benefit that goes to any one particular parent. It goes to the children. In order for it to go to the children have to be of a certain age if they are not disabled, and of any age if they are permanently disabled. If they're not disabled, then we're going to be thinking about less than 19. So an 18-year-old or younger at the end of the year qualifies so that the parent can receive some additional amounts in earned income tax credit. If that child, 19 up to, let's say, 23, is in college, is in technical school, it's training, and it's your dependent, then they also would qualify for this additional credit. Generally, as I've tried to explain, both the taxpayer and the child have to live in the United States for at least half of the taxable year and have to live with the taxpayer unless there is that non-custodial parent agreement on record at the IRS. This is again the form, as I'm reminding you, the 8332, so that you can let the IRS know who will be claiming the kid if it is someone other than the person that physically has the custody of the child. As I said, the IRS really disfavors the married filing single status. They put extra hurdles on individuals in that position to be able to claim these earned income tax credits. It's going to be important that there has to be an order of separation. This is not available in every state, but some states allow that even if the parents are not divorced, and they may even be living in the same household because they cannot afford yet to separate the properties, there's an order that declares them legally separated. If you have that, You're going to have to provide that to the IRS for them to allow you to claim the children. I have here some numbers. These are going to change. They change every year, but for this taxable year, 2025, if you have one qualifying child, you may receive up to $4,328. But again, that's going to depend. The more you earn, the smaller the EITC is. The older your child, the less the EITC. So that's why it's up to. And the numbers increase and change if there's more dependents. Another credit that is important for individuals, for couples or former couples that have children is the child tax credit. Again, let us think about where the child lives, who the child depends upon, and plan in case we need to file that custodial, non-custodial agreement. Generally, you can receive up to $2,200 per qualifying child. In this case, the age is lesser. This is only available when the child is 16 or under. So the child cannot be 17 on the last day of the year, okay? 16 or under. This has a refundable and a non-refundable portion. So when something is non-refundable, it means it can bring your liability down to zero, but then whatever's left, you don't get. In this case, there is a refundable portion. So even if you don't owe any taxes, you can receive up to $1,700 per qualifying child. But in order for you to receive this money, you must have earned at least $2,500 per year. Before I go on, there's a lot of numbers involved in tax law, but I want you to really go ahead and understand that there's software that calculates all of these things for you. If it makes you nervous, again, go to a VITA center or an ARP center. You are not going to have to make any of these calculations. The software, if you're filing online, hopefully, is going to do that for you. I would not recommend that anybody be filling out their tax returns by hand. There's just too much risk. Like I said, for the EITC, there is a requirement. Everybody involved, the taxpayer and the dependent children, have to have a social security number. It had been different in years prior, especially during the pandemic, but that is no more. Everybody has to have a social security number. Remember, as I said, here's the red star, remember the non-custodial agreements, because that is going to affect whether or not a person that does not have the children living with them for at least half the year can claim the children. It's similar to what I had explained before. Very well. This is different. It's the Child and Dependent Care Credit. This is generally a credit that is not refundable. It can lower your tax liability or bring it down to zero, but no more. You are going to have a dependent qualifying child that is younger even than the other credits. It has to be 12 or younger. Once the child is 13, they no longer qualify. And what does this do? If you are working or searching for work and you have had to hire a reputable daycare center, an organization that has an employer identification number, then you can submit a letter or at least demonstrate the letter to your accountant or your tax preparer showing how much you have spent during the year in daycare for this child. It could be aftercare from school. It sounds a bit complicated again because numbers, but again, the software does the calculation for you. It's going to allow you to recover up to 50% of your costs. But there's another but. So long as that 50% is no more than $3,000 for one qualifying person. And I will tell you that this, again, is going to be computed with regards to your income. So there's, again, charts that you are not going to see, but that are going to be part of the algorithm. And they're going to calculate how much money you can receive to lower your tax bill. This is the new chart. So when I say up to 50%, we're thinking about individuals with an adjusted gross income that is on the lower range. It would be about $50,000. If that is about how much you receive, then you can get up to 50%, again, so long as not more than 3,000 for one child, 6 for more. And as you can see, this is available even to individuals that are on the higher income bracket. So if you make $206,000 or more a year, you are going to be allowed to get a credit for 20% of what you expended on the daycare or aftercare activities. It's important. This is not for camps. It's not for private kindergarten. You cannot simply provide a letter saying that your older child took care of your younger child and you paid. No, it has to be a third party, preferably an organization that has an EIN, or in any event, someone that has their own taxpayer identification number. Okay, so let's now look at some of the more common tax conflicts. These are controversies that we have seen and that many tax law practitioners have seen come up in these situations. So we have to understand first, the general rule is that when two individuals are married, their spouses are generally expected to file a joint tax return. This is so because it's a policy decision, right? It's just the way it is. It could change, but this is right now what's in the Internal Revenue Code. When you're married, you're expected to file a joint tax return. And when you do, regardless of how much or how little a spouse earns, the spouses are going to be joint and severally liable. That means that the IRS can go after one or both, regardless of how much or how little that person actually contributed to the liability. Because for the government, really the important part of the equation is that the tax be paid so that the government can make those disbursements to pay for services. Now, we are assuming that all of this is happening with consent, right? But we're only going to have that joint and several liability if there was consent. There is an enormous mountain, a great big hill to go up to prove that consent was invalid. But one thing that is key is that the taxpayers have to be married. I've had a case where one of the taxpayers reported that he was married to the client. They were not married. They were fraudulent. He simply included her as a dependent. Then the IRS, relying on that statement, was coming after our client for a tax liability, except that since they were not married, that was not possible. So that's certainly a defense. That is much easier to prove than consent, because to prove that you didn't consent, you're going to have to show threats or duress. And I will tell you that the burden is heavy if there is some proof of abuse, domestic violence, whether it be pictures or statements to the police, to therapists, that can show that whatever happened during the relationship was probably not the result of meaningful consent. Obviously, if someone forges another person's signature and that can somehow be proven, that would also go to proving that it's not valid and that there was no consent. But there is such a thing as tacit consent, Did you, for example, just tell your spouse, like, oh, I don't like numbers, numbers give me a headache. You sign for me. It's okay. I'm not even going to look at it. Then you may not have truly consented, right? In the way we think about in everyday life, but you basically allowed the other person to make the decision. So you consented to them giving consent for you. This is going to be especially important when the taxpayer one, couldn't have possibly prepared their return without taxpayers two's forms, W-2s, 1099s. When we have a tax return that accurately reflects what both parties earned, it's more difficult to prove that there wasn't consent because there was at least some cooperation, right? And the IRS is also going to think about, well, did you in any way receive a benefit from filing jointly? And if you did, then they're going to question whether you really withheld consent or knew nothing about. So it is really important to think about when a joint return is filed without authorization. Like, how can we prove that, right? Sometimes we find that taxpayers are separated, and one taxpayer decides they want to file married filing separately, but the other taxpayer has already filed with them filing jointly. When that happens, that second tax return is going to be rejected. But what you have to do at that point is provide evidence to show that the joint return was not valid. I will tell you that just by the fact that you filed that second return, you are already ahead of the game because it shows that you lacked intent. Whatever happened that led to that initial return, probably was not consensual if you are, for some reason, going ahead and filing your own. You can show, for example, as I said, that you were not legally married, that the signature was forged because your ex is so familiar with your signature that they can basically forge it, or because they have been signing for you for all these years. So the IRS would have copies of your signature from other documents. And again, it's always going to be important that there's a substitute return. So again, if you went in and tried to file and it was rejected, you already are in the realm of number 3. Now, another problem that we have is perhaps you are both filing separately. Perhaps you are now as the head of household, the other one is a single, or so you thought, but it turns out that your former spouse, who does not have custody, who does not live with the children more than half of the year, has filed as though they are that spouse's dependents. I will say this can happen out of ignorance. People are not as familiar with tax law as they should be. So they could have possibly done that without meaning to defraud anybody. But there's going to be a situation that the IRS has to resolve because for IRS purposes, there can only be one parent who is the supporter, who can claim them as dependents. If this happens to you, what is really important is that you go ahead and you request an IP-PIN, as we discussed in the beginning. You should be requesting that for yourself. In the future, request one for yourself and the children so that going forward you have those and can prevent the filing. Once the IRS sees that there are 2 tax returns claiming children as dependents, they're going to be examining or auditing both taxpayers. You will have to provide the IRS with proof that these are your children, whether adopted or by birth. You're going to need a birth certificate, some legal document that shows your relationship. you are going to have to provide information regarding their residence. So it's important that your children's address be your address. Keep that updated with the doctors because you could get a vaccination record or a visitation record, the doctors or the school. It is very useful if you can provide some sort of certification to print up from the school that shows your address. If your children take the bus, that they're taking the bus at the bus stop closest to your house, not your spouse's. Again, this goes, because we're talking about IP pins, it goes directly into identity theft. It is extremely important that we understand that it happens in the situation where there's multi-household families, but it can happen with strangers as well. It could be someone has hacked into your computer, someone has picked up your wallet somewhere, and they're using your social security number to work because perhaps they don't have their own. And so they have been earning income that's reported to the Social Security Administration and to the IRS. And this is going to create a liability for you. So it's important when this happens, freeze your credit. You're going to be contacting the 3 credit agencies. You should talk to the Social Security Administration and explain the situation. What all the IT personnel always tells us, you're going to check your passwords, make sure that they're strong, that they're not your address, that you're not your birthday, that they're not easily breakable. Make sure that you start monitoring your financial statements, inform your bank. And again, IP pins are incredibly important. You have to report the identity theft to the police. The police will likely tell you that they don't have an identity theft unit, that this is not a crime to investigate, but you're still going to insist that they go ahead and allow you to file a complaint so that you have a complaint number. And then you're going to provide that information to the Federal Trade Commission. And I'm not sure why I included the Spanish language link, but please do go ahead and Google the Federal Trade Commission FTC identity theft to get the English language link. And you are going to be reporting that as well. It's a lot of work, I know, but you got to call or you got to somehow go to the website and submit your complaint about identity theft to Experian, TransUnion, Equifax. Once you have done that, make sure that you are filing an identity theft affidavit with the IRS. They also have to be informed, and they're probably going to want copies of all the other documents to the police and the credit agencies. Now, a little what I said before about whether something is valid or not is important and relevant, even if there is no semblance of abuse in their relationship. But unfortunately, we do know that in addition to identity theft and what seems like only financial violence, there's generally patterns of abuse that go beyond simply filing a fraudulent tax return. And so the IRS has developed what is known as the tax relief for innocent spouses. This is a procedure for explaining to the IRS your situation, and that while it might appear that you have cooperated by providing documents and information for the filing, by providing your signature to the tax return, you were not in a position that would have allowed you to reasonably deny this consent without putting yourself in peril. So I would like to begin by letting you know that if this is your situation, you will have to relive a lot of that abuse, a lot of the trauma as part of the process, because the IRS is going to expect a certain level of detail that helps it corroborate the information. You should also know that unfortunately, the IRS will also have to reach out to the other party. It is not that they're going to provide the documents and your stories, but they are certainly going to approach the other taxpayer and ask for their version of events. Um, so it's going to be really important, and even though it's fashion and oppressive, it's going to be really important that you have some evidence, that you have some witnesses, some pictures, some statements from your social worker or any complaints that you may have filed to help you support your claim. Now, there are technically three different versions of the innocent spouse process. There is the complete relief, where we would go through that very detailed and I think traumatic, or at least re-traumatizing process. But you have to do it because you have to show there was a joint return. Whatever misstatements there were on the tax return were not mistakes that you could have corrected or that you could have controlled. And even though we're speaking about misstatements, it could also be that there's no misstatement, that there simply is an outstanding liability that the other spouse didn't pay. You have to show that you didn't know or have reason to know about the misstatement, the understatement in liability, the failure to pay. And then from the totality of the circumstances, you're going to show that it would be unfair for you to be held responsible. So let's think about someone who does not have control over the couple's bank accounts, who really is not in a healthy relationship where the couple shares information about a business that is a family business, or where one of the spouses doesn't even know much about the work the other does. Again, this is going to be a little bit of an exhaustive process, and I'll walk you through the kinds of questions in a little bit. But there's also the possibility of separation of liability. It's important that here we're going to have individuals who are no longer married. And while you are not denying that there's a liability and that you should be held responsible for part of what is being sought by the IRS, what you're doing is simply asking the IRS to separate the liability and basically to rethink the financial situation so that it would be separate liabilities, like both of you were filing as single. Then there's the equitable relief, and I will say that it is extremely hard to think of a situation where someone could go through the exhaustive process of the other two sections and yet not qualify. But I would imagine that perhaps we would be thinking about situations that arise after the marriage has been dissolved or the liability has been incurred. It is important as you go through the process that you're able and willing to answer questions about what was your role in the household finances, whether there were any large purchases during the relevant years. We had once an applicant who believed that she shouldn't be held responsible because she didn't realize that he wasn't using the monies that she gave him to pay the tax liability. But suddenly she did realize that they were driving amazing new cars and they bought a house, a vacation home. So while she didn't know that he wasn't using the money to pay the liability, she was enjoying the fruits of not paying the liability and instead having a lavish lifestyle. So that did not go well. The IRS is going to want to know how you were involved, how much information you provided or knew, whether you reviewed and why or why not. If you are a Spanish speaker and your spouse is an English speaker, and perhaps your English is not as sophisticated, or really no English at all, I think that would be one factor that the IRS would look at in understanding why you didn't know that certain statements or misstatements were being made. The IRS is also going to look at whether there were special financial difficulties at the time, or perhaps physical difficulties, like was this liability incurred at a time when you really couldn't have known better because you were undergoing cancer treatment, or you certainly couldn't have put more energy into the tax filings because you were taking care of an ailing elder. Um, these are the kinds of situations I can think of. And of course, were you a victim of abuse, and how can we prove that? Now, if that is, as I said, too re-traumatizing, there are also other possibilities. In this case, when we're thinking about innocent spouse relief, we're thinking about an older debt, not something that would arise when you're filing now your taxes. If you do have a debt of that sort, just as background, know that you can establish short-term and long-term payments. You should also know whether it is now or a liability that arose earlier. If you have had a sudden change in your financial situation, your hours were cut, you lost your job, you can always place yourself in currently not collectible status. We can also think, for example, as someone who has been sued. I hope this happens to no one, right? But what if you're in an accident? Unfortunately, you hurt the other driver or passengers, you're sued and have to pay a court order damages. That is going to deplete your resources. Perhaps you have to dedicate a portion of your check every month to that by court order. You can place yourself in currently not collectible. More to the scenario of an innocent spouse, perhaps would be an offering compromise. You could allude to some of the situations and some of the violence or abuse that you underwent, but it wouldn't be in as much detail, right? It wouldn't require as much of the information as before. You would simply have to explain how the debt arose and convince the IRS that you do not have the resources at the moment and likely won't have the resources long term to pay off the liability. I want to remind everybody that the filing deadline is April 15th, 2026. If you cannot, for some reason, file on that day, you should file for an extension. There's a special form for everything, and there's one for that too. And so by filing that form, you're going to be allowed until October 15th to file your taxes. If you owe, unfortunately, there's going to be interest on whatever you owe, but at least it won't be a penalty because you asked for permission. Now, remember that the filing deadline for Virginia is a little different. It's later, it's May 1st. And I'm going to now ask our host to please stop the recording so that I can take questions.